Right, good afternoon everyone, and welcome to this External Reporting Board webinar on the International Accounting Standards Board's, the ISB's, discussion paper named Business Combinations, Disclosures, Goodwill and Impairment. We have a large audience online today, which is fantastic. Hope you're all safe and well. My name is Anthony Heffernan, Director of Accounting Standards at the External Reporting Board. And I am also joined today by Garly Sloosberg, the project manager who was responsible for drafting our submission to the ISB on this important project. This ISB project may lead to significant amendments to the current accounting requirements for business combinations, so we are keen to receive your feedback. I will start by providing some opening comments on this project, and then hand across to Garly, who will walk through some of the specific ISB proposals. The focus of the ISB's discussion paper, which is titled Business Combinations, is really about the accounting for business acquisitions. What information do the readers of the financial statements need when a company purchases another business? Business acquisitions are often large commercial transactions of strategic importance to the future performance of the company. Internationally, when you think of major acquisitions, examples such as Disney acquiring Pixar, Marvel, and Lucasfilms comes to mind. Disney, as a result, now has the current and future rights over Toy Story, Marvel superheroes, Star Wars, and Indiana Jones. Closer to home, a recent business acquisition that comes to mind is Kathmandu's acquisition of Rip Curl Australia, bringing together within one group two iconic retail brands. The ISB's discussion paper is focused on what information do users require to understand the accounting outcomes of business acquisitions, which in many cases includes the recognition of a goodwill balance, and the information on the subsequent performance of the acquisitions. Has a company's large investment in a new business been a success for the group as a whole? These are the types of questions that shareholders and other investors are asking. The ISB is also aware of the current challenges in accounting for goodwill, including the questions of how long should a goodwill balance be recognised? On the balance sheet post-acquisition, and the application challenges applying the current impairment testing, which is currently mandatory. In a COVID-19 environment of increased future uncertainty, you can expect that any goodwill balance arising from an acquisition will be under the increased spotlight, especially as the recognition of the goodwill balance is often supported by the assumptions concerning future revenue inflows. The goodwill balance is often the first balance on the balance sheet, which is highlighted by auditors for future and scrutiny. The ISB commenced this project before any of us could have predicted the events of 2020, and they have therefore extended the comment period from ending September 2020 to December, the end of this year, 2020. Hence why we are seeking your views at this time. During this webinar, we will have some polling questions to receive your feedback, which will be fantastic. The presentation will be for about 40 minutes, and there will be an opportunity to take any questions at the end. So please use the question comment box to raise any of those questions, and we'll try and answer as many as we can. The slides and a recording of this webinar will be made available on our website later today or tomorrow, early tomorrow. So let's get started through the material. The discussion paper was originally issued in March 2020. As I've commented on, the ISB have extended the comment period in response to the disruption caused by COVID-19. So the objective of this webinar is to briefly explain the importance of this topic to New Zealand, provide you with an understanding of the issues being considered by the IASB based on constituent feedback that they've already received. A number of people have already highlighted internationally concerns with business acquisitions. Sorry, we'll just pause for a second just to make sure the slides are showing for everyone. Okay, so sorry about that. We're back, and I understand some people weren't able to see the slides. Hopefully they're showing now. We've only just started, so you haven't missed a thing. So carrying on, this slide is highlighting the objective of this session for the next 40 minutes. We're going to be to give you an awareness of the awareness of the issues that the IASB has been considering. Discuss the IASB's preliminary views. So this discussion paper does discuss, or does highlight, quite firm views from the IASB, which allows us to provide feedback, which is fantastic. And finally, we'll tell you about the upcoming outreach event that we're holding on the 13th of October. So this is this is a teaser, this webinar for the upcoming event, which will be held with the XRB and the International Accounting Standards Board. That event will allow the opportunity to hear directly from the IASB. It will allow for the IASB to hear your feedback, and will allow for you to ask any questions directly to the IASB. So look out for that on the 13th of October. But for the next 40 minutes, we'll definitely give you an awareness, an understanding of the issues and the current preliminary views from the IASB that we can then react to and look to provide feedback. Okay, so just a few slides to highlight the importance of the discussion paper and to set the scene. So as I've already alluded to, acquisitions of other businesses are often significant investments of cash. So obviously shareholders, investors, analysts want to know information about that significant investment and about the returns that they could expect on an investment in another business. Often business acquisitions result in significant management considerations. It results in changes in processes and operations. There may be a change in focus from one division to another, resulting in scale back of some operations and increasing activities in others, resulting in changes to the employment base. Acquisitions will result in significant impact on the future financial performance and financial stability of the consolidated group. It is going to have a significant impact on the future financial statements. So that highlights its importance. As I've already alluded to, Goodwill will be of high interest to auditors and analysts, and will be subject to their increased attention. That's always been the case and will become under increased attention in a COVID-19 environment. Why is this an important discussion paper? The IASB is aware that subsequent impairment testing is highly subjective and costly to complete. So the IASB is looking to respond to those concerns. Just using this slide to highlight some recent All right, we're just going to take another technical pause. Okay, sincere apologies about that. Just making sure that everyone can see the slides as I move through them, which I understand you now can, but if you're having any issues, use the question box. We have got other parties monitoring that for us. So you should be able to see on the slide now recent acquisitions that we've had a look at, just again to illustrate the importance of this discussion paper, highlighting the significance of the acquisitions. First one, Kathmandu, is interesting. It's interesting for many people, and they've just recently released preliminary announcements around their 30 June 2020 results. And that acquisition is particularly interesting that it occurred around November last year, pre-COVID, and before we knew COVID was about to hit us. So it is interesting reading that one. So acquisitions largely often involve large transactions and result in large amounts of goodwill, and investors are very interested in how that goodwill balance is made up. Investors are very interested in the subsequent outcomes of those acquisitions and if there have been a success story or not. So we'll be talking about that. Okay, reasons for the ISB commencing this project. Yes, they've been aware that there are significant transactions, and they've been made very aware from constituent feedback that investors and analysts want more information about how successful an acquisition has been. When you look at the accounting standards, there is significant disclosure required when you first enter into an acquisition about how the goodwill was calculated, about what assets and liabilities were acquired, and how you determine the fair value of them in kind of the first period in which the acquisition happened. But investors have want more information about, in subsequent accounting periods, about how successful that acquisition has been. And Garley will talk a little bit more about the specific proposals around that, about continued information on that post-acquisition performance. In addition, why is the ISB commencing this project? As I've already alluded to, they have heard the concerns around goodwill. So they've considered a number of options there around how they can make the goodwill calculation easier. Is the current goodwill calculation effective? And whether amortization should be returned. For many of us that have been around as long as I have, we maybe fondly remember amortization of goodwill, simpler days where goodwill was just amortized over 10 or 20 years, and that was kind of the end of the story. Now you've got an annual impairment test, and there's very good reasons for that, and the ISB's been exploring that. Okay, so the discussion paper, just to let you know what's coming up for the next 20 minutes. We'll walk through, and Garley will do it for us, the expert, on these 4 discussion topics that are within the discussion paper. I could have added a 5th point of other discussion points, and there are other items in there, but these are the main ones. So we'll first talk about proposals around improving disclosures on subsequent performance of acquisitions. Then 2 and 3 about the Goodwill Impairment test, and can we make that easier, and can we bring back, or would it be appropriate to bring back amortization? And could the Goodwill test be simplified even further? So with that, high-level comments and giving you a bit of a taste of what's coming before us, I'll hand across to Garley to take you through each of those 4 specific issues and the ISB's preliminary views on them.
Thank you, Anthony, and hi, everyone. So the first topic that's discussed in the discussion paper that we're going to look into is improving disclosures on the acquisitions of businesses. So as we mentioned before, investors told the ISB that companies typically don't provide them with enough information about the subsequent performance of business acquisitions. In other words, investors said that they don't get enough information on whether a business acquisition has been successful or not in the years after the acquisition. And at the moment, there are no specific requirements in IFRS standards to provide such information in the financial statements. So the ISB is proposing new disclosures to meet investors' information needs in this area. So in the ISB's preliminary view, at the acquisition date, entities should disclose the strategic rationale for the business acquisition, which would be linked to the overall strategy of the business. Also, an entity should disclose management's objectives for the acquisition, which would be more specific than the strategic rationale. So to be like achieving additional sales of a certain product, for example. And thirdly, at the time of the acquisition, there will be a requirement to disclose the metrics that management would use to monitor whether the objectives for the acquisition are being achieved. Then, after the acquisition date, the ISB proposes that entities should disclose how the acquisition is performing against management's objectives, using the metrics that management uses to monitor the performance of the acquisition. The metrics that I mentioned would be those that are used internally by management, rather than metrics that are prescribed by the ISB. So entities wouldn't need to create information solely for the purpose of external reporting. Given that acquisitions are quite major transactions, it's expected that management would monitor the performance of an acquisition. But if this is not the case, then that fact would need to be disclosed. In terms of how long these disclosures should be provided for, in the ISB's preliminary view, the information about the performance of a business acquisition should be disclosed for as long as it's monitored by the chief operating decision maker of the entity. If the acquisition is not monitored, or if the monitoring stops within less than 2 years, then an explanation for this should be disclosed. There are some other disclosure-related proposals in the discussion paper. For example, in the ISB's preliminary view, entities also disclose a description of the synergies that are expected from the business acquisition, and also the range of amounts of these synergies. Now, the next few slides summarize some of the potential concerns in relation to the proposed disclosures on how acquisitions perform after the acquisition date. And they also show the ISB's responses to these concerns. So one potential concern is around the costs of providing these new disclosures. The response to this is that entities, as I mentioned, entities would need to disclose information that management already uses internally to monitor the acquisition. So they shouldn't need to create new information solely for financial reporting. Also, these disclosures about subsequent performance would be required only for those acquisitions that are monitored by the chief operating decision maker. So it wouldn't necessarily be every single acquisition. Another concern that often comes up is that it might not be possible to track how the acquired business performs in subsequent years separately from the combined business, because sometimes the acquired business is integrated into the existing business very quickly. The ISB expects that in such situations, management would still monitor the performance of the acquisition and how successful it has been, perhaps by looking at the performance of the combined business. The proposed new disclosures would be able to be provided for the combined business if that is how management monitors the acquisition's performance. Another possible concern is that information about management's objectives and targets for an acquisition could be commercially sensitive. But the ISB thinks that it should be possible to provide investors with the information that they need about how an acquisition performs without giving away commercially sensitive details. There have also been some concerns about the verifiability of the disclosures when they need to be audited. The ISB thinks that it should be possible to objectively verify whether the information disclosed is in fact used by management to monitor the performance of the acquisition, and whether it faithfully represents what it purports to represent. So now we have a poll question for you, and hopefully I can get the poll to launch. So if you can see the poll on the screen, we'd like to know if you think that the proposed new disclosures on the subsequent performance of acquisitions would provide useful information to users of the financial statements. Thank you very much. I see responses coming in. I might close the poll now. And let's see what results we got. Hopefully you can see the results on the screen. So that's interesting. So 55% of you say yes, the disclosures would be useful, which is good to hear. I guess 30% unsure, which is understandable since this is all new information, and 15% say no. So thank you very much. This is very useful. So now we move on to the next topic, which is all about accounting for goodwill, looking into whether the goodwill impairment test can be made more effective, and then also looking at whether we should reintroduce the amortization of goodwill or stick to the impairment only model. So before we discuss the IASB's preliminary views in this area, I'll just give you a quick reminder of what goodwill is and what are the current requirements on the accounting for goodwill. When an entity acquires a business, the entity needs to recognize the assets and liabilities of the acquired business on its own consolidated balance sheet. The acquirer needs to recognize all the assets they've paid for in acquiring the business, including certain intangible assets that the acquiree hasn't recognized on its own balance sheet because they didn't meet the accounting rules for being recognized. For example, IFRS standards don't allow the recognition of certain internally generated intangible assets like brands, but these brands like that would be separately recognized in a business combination, in an acquisition of a business. Once all the assets and liabilities of the acquiree have been recognized on the acquirer's balance sheet, the acquirer would then compare the transaction price that they paid for the business with the fair value of the net assets that have been acquired. When the amount that was paid to acquire the business is higher than the fair value of the net assets recognized in acquisition, the excess amount is recognized as goodwill on the balance sheet, which is an asset. This goodwill asset represents the expected benefits over and above the benefits embodied in the individual assets that the acquirer has taken over. This includes expected future benefits from the acquired businesses, processes, and other internally generated intangible resources that allows the acquired business to keep coming up with new products, find new customers, and therefore generate returns above the value of the individual assets in that acquired business. The goodwill asset also represents expected future benefits from combining the acquired business with the existing business. For example, being able to sell more of your existing product through the acquired business's distribution channels, or cost savings from combining the two businesses. And these benefits are known as synergies. Until 2004, IFRS standards required entities to amortize goodwill over its useful life, so that the goodwill asset was gradually decreased over time to nil. In 2004, goodwill amortization became prohibited, and instead goodwill must be tested for impairment every year. What do I mean by impairment? An asset is impaired when the amount at which it's carried on the balance sheet is higher than the cash that could be generated by either continuing to use the asset or by selling it. Because of the nature of goodwill, it doesn't generate cash flows independently. We can't sell goodwill separately from the rest of the business, and we can't really use it separately either. So goodwill must be tested for impairment as part of a group of assets that work together to generate independent cash flows. And a group like that is known as a cash generating unit. For a cash generating unit that contains goodwill, the impairment test requires determining the recoverable amount of the cash generating unit. By recoverable amount, I mean the higher of the total cash flows that are expected to be generated from continuing use of the assets in the cash generating unit and the amount for which the cash generating unit could be sold. The recoverable amount is then compared to the carrying amount of the cash generating unit, which is the value at which the assets within that unit, including goodwill, are carried on the balance sheet. If the cash generating unit's recoverable amount is lower than its carrying amount, then the goodwill allocated to that cash generating unit is impaired. One concern that the IASB has heard from stakeholders about goodwill is that goodwill impairment losses are being recognized too late. The IASB thinks that there are two main reasons for this concern. One is that management can sometimes be over-optimistic when estimating the future cash flows for the purpose of the impairment test. The other reason has to do with the mechanics of the goodwill impairment test and the fact that goodwill must be tested for impairment together with other assets. As I mentioned before, goodwill is tested for impairment as part of what's known as the cash generating unit. Future cash flows from items that are not recognized on the entity's balance sheet, like say unrecognized internally generated intangibles within the existing business of the acquirer, can sometimes shield goodwill from impairment. I will not go into shielding in detail today, but there is more information about it in the discussion paper. After a lot of consideration, the IASB decided that it's not feasible to devise an impairment test that would be much more effective than the current test at recognizing impairment losses in a timely manner and at a reasonable cost. The IASB concluded that since goodwill can't be tested for impairment directly, shielding can't be completely avoided. The IASB did try to design an alternative impairment test that would reduce shielding, but even that alternative method did not completely eliminate shielding, and it also came with its own shortcomings. It's also important to remember that the purpose of the impairment test is to ensure that a group of assets that includes goodwill is carried on the balance sheet at no more than its recoverable amount. And the impairment test does achieve this purpose if it's performed correctly. So the impairment test is not designed to provide information on whether an acquisition is performing well or poorly, but the new disclosures that the IASB proposes on how an acquisition performs after the acquisition date should provide this information to investors. Finally, the IASB acknowledges the concern that management over-optimism can sometimes delay the recognition of goodwill impairment losses, but in the IASB's view, this concern is best addressed by auditors and regulators rather than by standard setters. So having concluded that it's not feasible to make the impairment test significantly more effective, the IASB then considered whether to reintroduce the amortization of goodwill. Now, the IASB is aware that there are arguments both for and against amortization, and both for and against retaining the current impairment-only model. For example, some argue that under the impairment-only model, goodwill balances tend to be overstated and stay on the balance sheet for too long, and amortization is a simple mechanism to fix this. Others argue that it can be difficult to reliably determine the useful life of goodwill and the period over which its value diminishes, which can make the annual amortization charge rather arbitrary and therefore not very useful, whereas the impairment-only model results in useful information. Also, some say that goodwill is a wasting asset whose benefits get consumed over a finite period, so amortization is the best way to reflect this. On the other hand, others say that goodwill generates benefits over an indefinite time period, so amortization would not be appropriate. There is also a debate about how much costs could be saved under the amortization method as compared to impairment only. The IASB is aware that neither the current impairment-only model nor the amortization model are perfect. Both have well-known advantages and disadvantages. Ultimately, the IASB came to the preliminary view that there is no compelling evidence to change the current requirements, so it's proposing to retain the impairment-only model and not to reintroduce amortization. Having said that, the IASB is interested to hear any new information or new evidence that would help settle the impairment-only versus amortization debate. And now we have another poll question for you. Which hopefully you can see on the screen. Do you prefer to retain the impairment-only model for Goodwill, or would you prefer to reintroduce Goodwill amortization? I'm going to close the poll soon. I'll close it now. And hopefully you can see the results on the screen. That's interesting. We've got a 41-59 split. And I see that people do have definite views on this. No one is unsure, which is, yeah, it is. I guess it has been a hot topic for a while. So not really a 50-50 split, but relatively close to that. So yeah, we can see that there are mixed views, which is very interesting, and looks like overall there is a majority that prefers narrow majority rather that prefers amortization. So thank you very much. Very interesting feedback. So now we move to the next topic. So to recap, the IASB's preliminary view is to retain the impairment-only model. And having come to this view, the IASB then considered if they can simplify the impairment test to make it less costly and complex for preparers to apply. So the first part of that is proposed relief from the annual impairment test. For most assets, the impairment test is performed only when there are indicators that impairment has occurred. But for Goodwill, the impairment test must be performed every year, regardless of whether there are indicators of impairment or not. To reduce the cost of the impairment test for preparers, the IASB's preliminary view is that it should remove the requirement to perform the Goodwill impairment test every year. This would mean that entities will need to perform the impairment test for Goodwill only when there are indicators that impairment has occurred. And now we have the poll question for you. So the question is, do you agree with the proposal that Goodwill should be tested for impairment only when there are indicators of impairment? Or do you think that the impairment test for Goodwill should continue to be mandatory every year? And I'll close the poll now. And let's see what the results are. Yeah, so we have a big majority agreeing with the IASB's preliminary view that the impairment test should only be performed for Goodwill when there are indicators of impairment. Great. Thank you very much for that feedback. So now, carrying on with the simplification theme, the IASB also reached a preliminary view that it should simplify the value in use calculation which is required as part of the impairment test. And I'll explain what I mean by value in use now. So in testing goodwill for impairment, an entity needs to determine the recoverable amount of a cash generating unit that contains goodwill. Recoverable amount is the higher of the cash generating unit's value in use and the amount for which it could be sold. And value in use is the cash flows that are expected to be generated by continuing to use the assets within the cash generating unit. And these cash flows need to be discounted to present value. So the current requirements are, when estimating the value in use of a cash generating unit containing goodwill, entities need to estimate the forecast cash flows on a pre-tax basis and discount them using a pre-tax rate. Also, entities have to exclude cash flows from future uncommitted restructurings and from future from asset enhancements. The ISV has heard from stakeholders that from preparers rather, that working out which cash flows to exclude from the calculation makes the test costly and complex. The ISV has also heard that pre-tax discount rates are generally not observable, and that is why the test is actually usually performed on a post-tax basis, and the pre-tax inputs are then worked out for disclosure purposes. So the ISV's preliminary view is to allow the use of post-tax discount rates and post-tax cash flows in the value in use calculation, and to remove the restriction on including cash flows from uncommitted future restructurings and asset enhancements. There is some small print there. It's not going to be free for all necessarily, but I won't go into that today. So we have the last poll question for you. So the question is, do you think the current impairment test calculation should be simplified, bearing in mind the simplifications that are being proposed by the ISV? And I'm going to close the poll in a few seconds. And let's look at the results. So most of you think that yes, the impairment test calculation should be simplified. A small percentage say no, and 14% unsure. But yeah, 77% say yes. And that's very useful feedback again. Thank you for that. So the webinar is coming now closer to the end. And today we've today we provided some background on what the discussion paper is about and touched on some of the key matters on it, but we haven't covered everything that's being discussed there. So if this webinar piqued your interest in the discussion paper, it would be great if you could join us for our virtual outreach event next month on the 13th of October. That event will feature presenters from the ISB, including the Vice Chair, Sue Lloyd. And it will be a great opportunity to hear about the discussion paper in more detail directly from the ISB and to discuss your views with the ISB and with us. You can follow the link on the slide to register, or you can register by going to our website, clicking on Information Hub at the top, and then clicking on what's coming up, and you will see the Goodwill and Impairment outreach event. If you receive our NZASB update newsletter, you would have already received these registration links. We hope you can join us and discuss with us the important topics of goodwill and reporting on the acquisition of businesses. On our website, you can also find the full discussion paper and a very useful snapshot summary document that the ISB prepared. And just a reminder that comments are due to the NZASB by the 2nd of November, or you can comment directly to the ISB by the 31st of December this year. your feedback on this discussion paper is very important because, as we've outlined in this webinar, the discussion paper deals with quite important topics, accounting for goodwill and disclosures on the acquisition of businesses. So any changes in those areas that might result from this project would be quite important for entities that are involved in business acquisitions and have goodwill on their balance sheet, and of course for investors and other users of the financial statements of these entities. And now we will pause for some questions. Have we got any questions on our panel? Yeah. If anyone has any questions, please feel free to put them in the question box now. If there are no questions at this stage, then we are going to finish the webinar now. Thank you very much for listening and participating. And hopefully we will see you at the outreach event. And also feel free to contact us directly to discuss the discussion paper further. Thank you very much and have a good afternoon.